Good afternoon, everyone. Just going to give another minute or two to let some last minute people log in, and then we'll get started.
Oh, that, sorry, just remember walking by, that Ostrander, air verification, I tried to find the house, find, we made one, right? I mean, yes, we gotta redo that. Are you, I just believe wanted to create one, no, we did create one, I just moved from the conversation. I mean,
All right. To be respectful of everyone's time, why don't we get started? I want to thank everyone for joining today. Before we get started, we want to take care of a little bit of disclosures and disclaimers. While we will be discussing some ideas that will have to do with investments and taxes, please understand that everything today is meant to be educational and should not be considered individualized investment, legal, or tax advice. As you'll see up here, this is not a guarantee of any type of profit. It is just a strategy that we are helping to educate as it may be beneficial for some of those that are on the call. With that out of the way, I'd like to introduce you to the Legacy Group. The Legacy Group here, our mission is to help you live a life of greater confidence, choice, and financial freedom. And we do this through strategic planning and unparalleled advice. What our approach is a service first, three-dimensional approach where we not only work with you to help with your financial, but we also take legal and accounting into consideration to make sure that all of your key matters are being addressed and everyone is pulling in the same direction. Moving forward, the agenda for today. I'm very happy that Rob Capra can join us and can bring to you some ideas on tax loss harvesting, what it is, and why it may be valuable for you to implement in your strategies. Direct indexing, how when you implement one, they coincide with each other. Jeff is going to focus a little bit on the velocity of money and how a switch within the way you look at things and think could have tremendous effects on the future growth and viability of your investment strategy. And we will discuss some other topics that will be coming up in our webinar series throughout the remainder of this summer, as well as the rest of the year. Today, again, I'm very happy to welcome Rob Capra. He is our Director of Wealth Management. Rob is a CFP and has 19 years of experience. Also presenting today is my partner, the managing partner and founder of the Legacy Group, Jeff Velastegui. Again, I'm just here just to kind of move things along, so don't worry about me. The other two are the stars of today's show. So why are we having this? I think one of the main reasons that prompted us to have this conversation with you is there's a thought out there that why do I need investment advice if I could just buy an index, hold it, and I can get on average 10% rates of return like the S&P has managed for since inception. And it is a great idea, but what inherently is missing is what we consider a silent fee, and that is taxes. That is something that you don't look at when you look at what your rate of return is. The money that you spend on taxes is money that is no longer being put to work to grow and compound over the remainder of your lives and your investment planning. So the goal today is to bring to you an idea that might change the way you look at how to manage your investments on a more tax efficient basis and bring to you some ideas that might provide value as you continue to grow in your financial planning. With that being said, I'm going to hand the reins over to Rob, and I think you guys are in for a treat today.
Perfect. Thanks, Rob. I appreciate the introduction. And it's funny, I'm actually coming up on 20 years doing this relatively quickly. And, taxes are an interesting conversation. We'll talk a little bit about tax loss harvesting, why it's appropriate, where it fits in the context of somebody's plan. In 20 years of doing this, I've never actually met anybody who wants to pay more taxes. I did have a strange experience a week or so ago. Met with a client who actually made a voluntary payment towards the national debt. And that was the first one in 20 years. Turns out, if you look at the data, a whole bunch of people do this each and every year. So if you're interested in paying more taxes, certainly explore that. But what we're going to talk about today is how we actually save on taxes. I think that's a more, critical piece of the conversation. So let's start with a high level framework. What is tax loss harvesting? Tax loss harvesting is essentially a strategy where we can sell securities that have declined in value and realize a capital loss. Now, nobody likes losing money when they invest in anything, clearly, right? The reason why we invest is to grow our portfolios to accomplish our various different goals. However, sometimes losses can have a bit of a silver lining. And when you invest in any type of security, if you do take a loss and realize that loss, the IRS gives you some tax benefits. So by any time you sell something, you can offset some capital gains elsewhere, which we'll explore a little bit further as we get into the discussion. Or if you don't have capital gains anywhere, then you can offset some ordinary income. So we'll talk about that, how it applies to direct indexing itself. Let's talk about the mechanics of tax loss harvesting first, though. So if you have a portfolio, and let's say it's made up of a whole bunch of different stocks, and you can look at across your portfolio, the first thing you want to do is, well, I want to identify anywhere where I have some losses. Let's say I bought into a company, a couple months, a couple years back, and you're going, ooh, that wasn't the greatest decision that I made. I've lost some capital on that. Step two is, well, you have to sell it, right? The IRS doesn't allow you to recognize the loss if it's just on paper. We have to sell that security, take the loss. That loss now exists and lives on our balance sheet. Step three is we can offset gains elsewhere in our portfolio. So, for example, if I had a stock that I sold at a loss and there was another one where I made a good investment and I had some gains, and I sell the two, they can net together to offset each other. And we'll look at some specific examples on that going forward. If I don't have any losses, if I don't have any gains in my investment portfolio anywhere, those losses can basically live on my tax return as what we call a carry forward. They basically sit in your back pocket, for lack of a better word, and you can use them in any year going forward. And in fact, they never expire. So if I lost $1,000 on a stock today and I didn't have any gains for the next 10 years, in year 11, I finally made some money on something, that loss can then be utilized to offset that gain. Now, there is a unique feature that if you don't have any capital losses, you can offset up to $3,000 of ordinary income. So if you had a W-2 job and your paycheck was $100,000 and you lost some money on a position, you can use up to $3,000 in any given year to offset those gains. Your accountant keeps track of that on your tax return. And if you're ever super nerdy and you want to take a look at it, check what's called your Schedule D, and that'll list all of your capital gains and losses. And it'll also have any of your carry forward losses that you can utilize in the future. Now, there are some nuances to this. The IRS doesn't allow you to essentially sell something and then immediately buy it back. They kind of got wise to that. So they have something what's called a wash sale. So if I sell a losing position to realize a loss, and then I use that loss to offset gains or income, I cannot buy that position back for 30 days afterwards, and I cannot have purchased it for 30 days prior. So they kind of put you in a bit of a timeout, a little bit of a penalty box, so to speak, where you've got this 60-day window before and after the sale date where you cannot buy the substantially identical security or the same security. Now, keep that word same or substantially identical in the back of your mind because that is going to come into play a little bit later in the discussion. But you do want to be a little bit careful. A couple things to think about. If you're married and your husband or wife were to sell the stock and you were to buy it, even if you did it in different accounts, still violates the wash sale. If I've got multiple advisors, which we run into oftentimes, sometimes advisor A is selling a stock, sometimes advisor B is buying it. And unfortunately, they cancel each other out from a loss realization standpoint because it was done within that 30-day period. So as you're evaluating your portfolio, we always just want to be aware of, what the actual rules are and how you want to make sure that you don't get yelled at by your accountant come the end of the year. So here's what it looks like in practice. This is just a very simplistic example. So let's say, for example, I bought company stock A, and that could be any company that's out there. Let's use Apple for an example. I put $10,000 in Apple. It went down to $5,000. And I said, ooh, I don't want to own Apple anymore. I want to do something different with those dollars. I sell my Apple stock. I now have a $5,000 realized loss. And again, like I mentioned earlier, that just lives on my tax return. But let's say I bought Microsoft around a similar time and I made $5,000 on Microsoft stock. Well, I could now sell Microsoft. I realize that $5,000 gain. And the cool part about tax loss harvesting is that they get to cancel each other out. My $5,000 loss from Apple offsets my $5,000 gain from Microsoft. I now have a net taxable gain of zero. Now, the critical piece here is that if I sell a stock, I don't want to just sit there in cash because we still want to benefit from the growth. So I want to reinvest it in something similar. And we'll talk about that when we get into the direct indexing part of the strategy. But the idea typically for most folks is when they do tax loss harvest a position, unless of course you needed the funds for something to fund a vacation or pay for some retirement expenses, the idea is that you want to rebuild that position and put it back into something because what we don't want to be doing is just selling things at a loss indiscriminately and then missing out on any sort of rebound if and when that eventually does come. Now, the small example that we just gave here is a very nuanced and very little example, but this can be done on much bigger scales, and there's no limit to how many times you can do this throughout the course of the year. So we used a $5,000 loss for an example, but that could apply to 50, 500, $5 million worth of losses. Now, clearly, we hope that you never end up in a position where you have a $5 million loss because that's a lot of taxes you want to write off in the future. But ultimately, there's no limit to the dollar amount as to the maximum you can go about doing this for. So when is this most effective? So let's talk about different strategies and ways that you want to look to utilize this. First and foremost, you do need a bit of a volatile market. If you own 5 stocks and all those things are going up, or you own 5 funds and they're all going up, it's difficult to tax loss harvest because you just don't have any losses. As I mentioned, losses are never fun from an investment portfolio standpoint, but there's a little bit of that silver lining that they can be useful from a tax perspective. And the second thing is that this needs to be done inside of a taxable account. So if you have, let's say, a non-qualified brokerage account, non-qualified is just a fancy way of saying a non-retirement account, this strategy will be useful. If it's in a 401k, an IRA, a Roth account, those are all what's considered qualified accounts. Tax loss harvesting does not work in those. So if you made a bad investment inside of your IRA and you took a loss on it, unfortunately, there's no way to go about writing that one off. It has to be done inside of your non-retirement accounts. And then the third thing is high income households. So the higher your income is, the higher your capital gains tax bracket is going to be. Technically, there's 3 different capital gains tax brackets. You can end up in a 0%, 15, or the maximum would be 20. If you're in that 0% capital gains bracket, then it really doesn't matter. But if you find yourself in a 15% capital gains bracket or a 20, tax loss harvesting becomes much more effective because every $1,000 that you don't pay taxes on saves you somewhere between, call it $150 and $200 in totality. So those are the 3 criteria generally that you're looking for where tax loss harvesting becomes most effective. If we want to jump forward for me one, please. So let's take this to a little bit of a different level. So we just talked about the concept of tax loss harvesting. So again, I'm selling a security at a loss to then realize that loss, and that loss becomes then useful on my tax return, and then I can offset a gain elsewhere. So direct indexing is a strategy that essentially takes us to a whole new level. If you think about indexing in general, it's come through multiple different iterations over the years. Vanguard or some other fund families launched the first index fund. I don't recall the exact year, but it's been around for decades. The index fund was very efficient because it didn't buy and sell a lot of securities, so you ended up with some tax benefits. The next evolution of that was the ETF, or an exchange traded fund. Trades like a stock, and again, had some additional tax benefits behind it. And that's been very popular probably for the last 12 to 15 years. The most recent iteration of kind of the future of index investing is what we would call a direct index. So a direct index is, instead of buying a fund or an ETF that replicates the index, I actually want to own the entire basket of securities that makes up that index by itself. So for example, the S&P 500, probably one of the most popular indexes out there, represents 500 companies here inside the United States, mostly large companies and all names that you'd be familiar with. But like the name implies, there's 500 different companies that make up that index there. If instead of buying a fund, I bought all 500 companies in the exact same weightings and percentage that the index would track, well, guess what? I just replicated the index in a much more complex fashion, yes. However, that provides me some additional opportunities for tax efficiency and greater levels of control. And we'll talk about that as we continue to go through it. If we can jump forward one, please. So here's why you might consider a direct index, let's say, versus that traditional just S&P 500 index or a Vanguard fund. One, as I mentioned before, we're owning most or all of the stocks within the index itself. So I can apply what's called a values-based screen if I would like to. So for example, if I had a thing against gambling, I thought I didn't want to express my views with my dollars in any companies that support gambling, I could put a screen on my direct index that says kick out any company that has any gambling affiliation. The same can be done. The common ones we typically see are things like tobacco, firearms, companies that, may have unfair business practices. There's really no limitation to the values that you can screen a direct index for. And we have plenty of clients who come to us and say, I want to express my views with the money in a very specific manner. And I want to make sure that we're not allocating to these types of companies that, participate in these different things. So that's the first thing. The second thing is that you can choose various different sector and factor tilts. So a great example, we're working with a client right now. He works in the tech space. He went through, what would be considered a very large IPO and now owns a lot of stock in his company. Well, most of his net worth is tied to that company stock right now. So one of the things we did in his index was, well, we don't want to have technology exposure there. We've got enough of it on the left hand over here. So on the right hand, when we built out his direct index, we were able to say, let's remove any of the technology sector exposure because we've already got that covered on the other side. We're not duplicating our efforts. We're not creating this unintentional exposure that we don't need. And then third, and most important, at least for our discussion today, is the flexibility to manage taxes at the individual stock level. As I mentioned earlier, if I bought stock A and took a loss and then sold stock B for a gain, the two get to cancel each other out. That was just two different stocks. Imagine if we did this on a much larger scale. If you take the S&P 500, for example, there's 500 different companies within it. What we found, though, is that you don't actually need to own all 500 companies to replicate the performance in the index. Depending upon which firm you talk to, you can actually basically track the performance of the index by owning anywhere from 120 to 180 stocks out of the 500. But what that does for us, if I only own 180, that means there's 320 other stocks that are now sitting on my bench that I could essentially swap in and out at any point in time using that tax loss harvesting strategy that we talked about previously. So if we move forward one, we can talk about, what the mechanics of that actually look like. So here's how direct indexing actually enhances the tax loss harvesting. So again, I own 180 stocks. There's 380 that are sitting on my bench. Anytime one of those stocks goes down, I have the ability to sell it, take a loss, and I've got now 380 possible replacements sitting over here that I can then swap in. If you remember earlier in the discussion, I mentioned that same or substantially identical is a key term from the IRS's standpoint. And what that means is that if I sold Apple, I can't buy Apple back, but guess what I can do? I could sell Apple and perhaps I buy Microsoft. Perhaps I buy Google or Facebook or any one of the other technology companies that are out there that when you look at the performance of those stocks tend to follow very similar. So again, the idea is that if I'm selling a company, I don't want to just sit on the sideline. I don't want to take a loss just for the sake of taking a loss. I want to rebuild that position with something that's not identical, but looks and feels very similar. So I'm still benefiting from that performance. Now, if I do this on an ongoing basis, my tax savings starts to compound. So if each and every day I'm looking at my portfolio and I'm selling some positions at losses, selling some others perhaps at gains and negating those, or building up those losses on my tax return, I can build that up throughout the course of the year and my tax savings then just multiplies. Again, you can customize it to various different levels of flexibility to the extent that I may want to own certain types of companies. I may not want to own certain types of companies. I can be more aggressive with the harvesting. I can be less aggressive with it. All along the way, though, we do have to remember that we want to avoid that wash sale, right? That key 30 days prior, 30 days after that sale, because then we're negating the benefits of the tax loss harvesting. But again, from the direct indexing standpoint, now we can see this compounding tax savings over time, right? So I'm building up losses that can offset gains today. I can build up losses that can offset ordinary income, and any of those unused losses can then carry forward into future years. This can be very effective from a planning perspective, particularly as you approach retirement or make the transition into retirement, because for most folks, they're in their highest earning years in that 5 to 7 year window, as they start to lead into retirement. Once you retire, for most clients that we work with, your income is less than when you were working, which also happens to mean your tax bracket is less. And this affords, some very interesting opportunities. But again, that compounding tax savings, does build up over time. Now, there are always some risks and limitations to everything. As Rob mentioned earlier, there's nothing wrong with just buying an index and leaving it alone. We use index investing quite often here at the Legacy Group, particularly the Vanguards and the iShares and the, Schwabs of the world. So doing a direct index does add some complexity and cost. This is very difficult to do on your own, which is why we work with some of the major asset managers that are out there. Most major firms, Vanguard and BlackRock and Goldman Sachs and JP Morgan, all have their direct indexing product that's out there. Because as you can see, if I own 180 stocks and I'm trying to swap them in and out each and every day, it's very difficult to just log in your E-Trade account and do that on your own. You really need, one of these professional firms who've perfected this to do this. Now, there is what we would call potential tracking error, meaning that I'm tracking an index as closely as I can, but because I'm always swapping some stocks in and out, there may be a slight difference between the index performance versus the direct index. We try and keep that tracking error as tight as possible, meaning if the S&P did 10% for the year, our expectation is that you're doing somewhere between 9.8 and 10.2. So it's a very slim margin for error. However, there are periods of time where that may widen. And then certainly in a strong bull market, if everything I own is going up and to the right and there's no losses, well, there's really not much opportunity, for tax loss harvesting. And that would be true for if I owned individual companies, as well if I did it via a direct index. So there are some risks and limitations that we have to be aware of, but ultimately, we find these strategies very effective. Now, this gets into who would want to explore the strategies. Certainly high net worth folks who desire a customized portfolio, that's the first and foremost, right? If you have a larger portfolio and you go, I really want to customize this to the extent where I'm expressing my values from an investment standpoint. If you're trying to be really nuanced with how you invest your dollars, if you have large exposures, again, as I mentioned, the gentleman we're working with who he works for a technology company, so he's got a large position in stock in the tech company. We want to then build the rest of his portfolio to complement that. That's where it's extremely effective. If you're just starting out and you're contributing a couple $1,000s to an account and trying to build it up, direct indexing probably, doesn't work for you in that instance. We generally look at it in anywhere from $250,000 or more as kind of a number where it starts to make sense when you have a more conventional investment portfolio. Also, if you have a large taxable account, that's when it tends to be most effective. The larger your account is, the more potential for tax ramifications as you're buying and selling things. So you want to make sure that your account justifies, all the various different complexities that go along with it. Again, at a $5,000 level, you don't need a direct index. At 500,000 or 5 million, there's some substantial tax savings that can be had, from utilizing a strategy like that. And then last but not least, investors with significant taxable events. A couple of good examples that we've worked on, more recently. There is, again, a very large public IPO that happened over the last couple of weeks. I won't mention the name, but you're all going to be familiar with it. If you had, let's say shares or things like that that came due and you sold those shares, at a big taxable event, we can utilize the direct index to try and offset gains there. Our mandate then is actually just to realize losses. So if you envision it, I have a big gain over here. I can take my pool of capital over here within the direct index, and we can instruct these firms, say, we don't need any gains. We've got plenty of those. We just need you to book losses and aggressively book losses to offset, these gains over here on this side. So, we've seen that as a very effective strategy. And then certainly for business owners, who've gone through a liquidity event, we worked with some folks who sold a business. As part of that business sale, there was a large capital gain that was realized. We used a significant amount of those proceeds in a direct index, again, with the idea to try and drive losses. And we wanted to do that, to offset those gains from that business sale. The longer the time frame you have to let the direct index work for you, the more effective it can be. If you come to us in November and say, hey, by the way, I need to offset a whole bunch of gains, here's $1 million, put it in a direct index, and you give us 4.5 weeks to try and offset those gains, becomes challenging, just because we don't have the time frame to let the market, do what it does and work in our favor. Bring that to us in January and go, hey, now you have a full 11 and a half months to try and build up losses to offset some gains. The time frame starts to work out. So again, I think when you think about the direct index in conjunction with tax loss harvesting, if nothing else, you should be looking at your portfolio from a tax perspective. As Rob mentioned, taxes are kind of the silent fee drag on a portfolio. And if you're not paying attention to them, oftentimes they can sneak up on you. Even if a direct index isn't necessarily the strategy that makes the most sense for you, being sensitive from a tax standpoint and exploring some of those tax loss harvesting opportunities is never going to be a bad thing from an overall portfolio perspective. I'm going to turn it over to Jeff here
Rob,
to
thanks
kind
so
of tie
much.
these concepts together.
I appreciate it, Rob. Thank you so much for that, broad explanation and as to why we do this with our clients. And, it's so fitting because we have over the last, I would say, couple of months have had significant conversations with people about this concept of tax loss harvesting and why and who should do it, right? So before I, go on, beyond that, what is the velocity of money, right? And it's a concept that's not new, right? It's an economic term that's used to simply describe how efficiently money moves before it stops, right? Anytime it moves, it's either growing or you're buying something, but every time that the money stops, it no longer is efficient. So in the traditional sense, when you look at that and apply that to the retail investor, right? What does that mean to us, right? What does it mean to the regular individual who's going about life, earning money, paying taxes, et cetera, et cetera? So if you think about the tax system we're in, it's almost perfect and in favor of the IRS, right? And if you think about when you earn money, you pay taxes, right? And then whatever's left, you're either going to save it or spend it. When you buy something, you pay sales tax, right? And then when you save it, right, we run into the problem that Rob's been talking about here for the last 20 minutes, right? Which is the silent fee that you're paying is that hidden, income that your portfolio is generating, right? And all of a sudden you get a 1099 at the end of the year and say, okay, well, what do I owe an extra $40 or $50,000 for money that I didn't use? So, that right there, that example is the literal definition of an inefficient dollar, right? The dollar moves, right? But it gets, it stops the moment you have to pull money from another pocket to pay those taxes, right? So, we have very intentional conversations about that because what often happens and what we see people doing is they keep making the same mistake by reinvesting it in the very same thing that's generating that tax, right? So you kind of jump into that perpetual tax pool and you're, choosing to stay there unless you make an intentional decision, right? So the idea behind being intentional and looking at the velocity of money when we're planning for people is what can we do to repurpose dollars to do more than just one job? And what I mean by that is when people look at their investments, you just want to grow that money for some time in the future, either to use it for income or pass it down for the next generation. But again, a lot of times we talk to people and we say, we can probably make you more money by saving you on the taxes that you're losing, right? Than we can by trying to get you an 8, 9, 10, 15%, because again, all arbitrary numbers. Because again, that when you think about compounding, compounding is one of the greatest forces in known to man, right? But that can also work against you, right? So any dollar that gets lost to taxes, if you look at the growth of what that dollar could have done for you and your family over the course of 5, 10, 15, 20 years, that is the scary part, right? So we're actually going to have probably one of the webinars later this summer on that very topic to actually illustrate the impact of it. So what do we do, right? So what we do for our clients is not only, yes, manage the portfolio, look at the inefficiencies from an investment strategy, whether it's, overweighted on any one particular stock, but more importantly, let's look at the tax drag. What is actually happening every single year when you're getting that 1099 and you go into your accountant and saying, hey, here's my documents, and then you get hit with a tax bill you weren't expecting. We take an intentional look at that, right, to make sure that If that is happening, what can we do? And Rob kind of went through kind of a bunch of those things that we are actively doing for clients. But more efficiently, there are other things, right? So Pam, if you can go to the next slide, please. You know, when you go through the trouble of tax loss harvesting, if you're already doing or using direct indexing, right? Um, that is your opportunity to say, okay, do I put that money back into the same bucket that's generating the problem that I'm in, right? Or do we look at a different strategy that's going to help keep me in what we like to call a tax never bucket, right? So in the most simplest terms, when we look at a person's situation, your money is in one of three places. It's in a taxable bucket, right? That's mostly your bank accounts, the joint investment accounts, anything that has a registration where you're basically you're bearing the brunt of any taxes, right? The second bucket is a tax deferred bucket. That tax deferred bucket are things like your IRAs, 401ks, 457s, pensions, and anything that basically the IRS said, it's okay, you don't have to pay taxes now. We'll collect those in the future, right? And that's the scariest of all the buckets for me. And I'll tell you why. When you look at our current tax, income tax, you have to ask the question, do we think the taxes are going to go up or down in the future, right? Rob mentioned that he talked to a client that, paid his, a portion of his, of whatever taxes towards the national debt, right? Never heard that either. That's a new one for me. But if you think about that number that keeps climbing, right? Everybody talks about it, but no one's actually doing anything about it, right? So when you think about your income tax bracket, you have to ask the question, do you think the taxes are going to be higher, lower, or the same than they are today, right? Now, keep in mind, at some point in our history, right, if you think back of our tax system, back in the World War II era, right, we got ourselves into a war, we spent a bunch of money, and we found ourselves in a situation of how do we pay for this, right? So they raised taxes. And a lot of people don't know that taxes at that point were upwards of 90%, right? And in the 70s, that went down to 70% of income tax bracket. But, and ultimately today, we are probably in one of the best tax systems than we have been in the entire history of the United States. So that said, right, when you think about the national debt that, problem that we have, right, we're spending more, we're not making enough. At some point, that debt has to get paid in some way. And again, going back to why that middle bucket, that tax deferred bucket, is the most dangerous one, is because we know that at some point the government can, right, and has the option to say, we're going to raise taxes. So, you're leaving it up to them to decide how much you paid in taxes. So that middle bucket, that tax deferred bucket, is where we see a lot of people have their money, because conventionally that's what we've been taught to do. Defer the taxes because you want to save your income taxes today, not realizing that long term that could be the biggest mistake you're making, right? So again, it's not applicable to everyone. We want to make sure that you understand that, at the end of the day, this applies for people that have an abundance of wealth and more income than they're using. And again, when you find yourself in that situation, it's very important to decide, okay, do I want it in a taxable bucket, a tax deferred bucket, or a tax never bucket, right? Which is things like Roth IRAs, SPIA purchases, charitable giving, and reinvesting in other assets that are going to keep your money moving in one direction, which is growth, and hopefully without not having to pay any further taxes. So, Rob, I don't know if you want to chime in and add to that, but that was kind of my part of this conversation. So thank you for writing that article, which I think is very appropriate for a lot of the people we work with.
Yeah, and I think it's a perfect point, Jeff, in the sense that, tax rates now are probably lower than they've been in a long time. Ultimately, I do agree that at some point they're probably going up. And, by utilizing some of these strategies, you can then structure those different strategies on the right a little bit more effectively. And Roth conversions, charitable giving, SPIA is not necessarily for everybody, but as our clients and as clients think about the overall architecture of their financial plan, if you're going to try and execute any of those things, if you can do it in conjunction with lowering your tax bill, never a bad thing to be doing. So I appreciate the conversation and glad to join today.
If I could add something, Jeff had brought it to our attention. It's a book that we are reading. It's called The Power of Zero. And the overlying theme is to get yourself into the zero tax bracket in retirement. And to Jeff's point about us being in one of the lowest tax environments we've ever been in, they specifically brought up Ronald Reagan, when Ronald Reagan was an actor, he was one of the highest paid actors of the time. And at his time, anyone that earned over $200,000, once they hit that cap, every dollar over that was going to be taxed at 80%. So what Ronald Reagan did was he typically worked two movies. Each movie paid him $100,000, and then he didn't work the rest of the year because every dollar earned over that, he was only keeping 20 cents and the government was getting 80 cents. Now, we're not trying to say that we're going to go back to that, but those who ignore history are doomed to watch it repeat itself. So being intentional with your planning, and what I hope you all take away from this, is that taxes are one of the few things in investing you actually have control over. Being intentional with what you do, watching everything that you do, and understanding that there are going to be ramifications to decisions today, having a complete and comprehensive financial plan is, it's paramount to making sure that your financial future and your family's financial future is set up in the most efficient way possible and helps you achieve your goals. With that being said, as I mentioned earlier, this was strictly for educational purposes, not to be considered any type of individualized advice. For any of you on this presentation that would like that individualized event, Pam is going to move to the next slide. That's going to have a QR code. If you scan that QR code, you are able to book a complimentary consultation. In that, we will be able to look at your specific situation, look at all the good that you have done to get you to where you are today, and perhaps provide some guidance and some feedback on ways that we might better help you get to where you're trying to go in a much more tax efficient manner. With that being said, I want to thank Rob and Jeff for their participation today and everything that they brought to the table. I want to thank everyone who attended, and we look forward to being able to help you in any way that we can and setting up meetings to discuss your specific needs. Thank you all.